Hello, everybody, and welcome to this Q&A session. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats. Got a couple of Earnings Beats folks with me. Got Matt Townsend, who I know a lot of you maybe write in to support, get responses from Matt. Matt's going to kind of moderate this, just give me some questions. I'll try to fire through them and get everybody the answers they're looking for. And then, of course, my son Tyler does the producing of all of our videos, or many of our videos at at Earnings Beats. But we're going to go ahead and get this thing started. So, Matt, questions you got for me?
So we got a relatively short list compared to the last couple weeks, but we're going to start with one from Daz. So in his weekly or in your weekly report, I see charts like QQQ relative to S&P or the SPY, the IWM relative to the SPY, etc. That including the gaps and ignoring the gaps. He was wondering what they signify. Being an extra at stock charts, an extra member at stock charts, is he able to recreate these charts?
Well, I'll tell you, let me go ahead and I had to get into my other account to try to explain this to you. So I have a user-defined index, and so you're not going to be able to show these charts on your own account because these are in my account. And so unless you're in my account, you can't print these charts out because I use the user-defined index. So they're resident only in my account. They're not going to be in your account. So but what I do is I just go in here and I update this every single day based on a formula in terms of looking at the intraday. So I'm looking at how I'm ignoring the gaps. And then, for instance, in this one, I'm just looking at the spider and the QQQ. And essentially, what happens is in order for this to go higher, in other words, for the intraday relationship for the spider versus the QQQ to go higher, um, the percentage gain during the day on the spider would have to be a higher percentage gain than on the QQQ. So I don't have the formula right here, but that's essentially what you're looking at. So we could see the spider and the QQQ have a much different relationship on a gap down. You could have one gapping down 1%, the other one gapping down 2%. So if you're pulling it up, spider versus the QQQ or the QQQ versus the spider, and you're just doing it on stock charts, it's going to include those gaps. So for instance, let me pull up QQQ colon spider. And when we do that, you're going to have these gaps. So you're going to have gap ups and so forth. And then it's going to, then it'll kind of, the rest of the day will kind of, you know, get that relative ratio where it needs to be based on from yesterday's close to where we are now. But when I do it, I haven't adjusted. Let me pull up my adjusted. This is what you see in the weekly market reports. But I have the SPY Q, which is really QQQ divided by SPY. The name says at SPY QQQ, but it's really the relationship QQQ divided by the spider. And so if I um, ignore the gaps, that's where my user defined index is going to come in. That's what is showing here. Or actually, no, that's what's showing up here. This is just, these have been moved a little bit. This ignores the gaps. So you can see it's been coming straight down. Even including the gaps, it's been coming down as well, but it's not exactly the same. And I just like to see what's going on after the opening bell because many times you can get manipulation, just get gap down. So I just want to see what is actually being traded throughout the day. The top panel is going to give you that. The bottom panel or this middle panel right here is going to give you um, the relationship, but including the gaps. So it's not really anything different. It's just given me a little different view of what's taking place during the trading day.
Gotcha. All right, we'll move on. We got a Monty just asking for a clarification. In one of your previous articles, I believe it was the January 24th article, he said, don't, or Tom said, don't bet against the secular bull advance. 1 week later, we exited all of our portfolio positions. Tom didn't say, but I'm guessing one message was more towards buy and hold investors, and the other was toward a swing trader. And he was just hoping to get a clarification on that.
Yeah. That's exactly what it is. I mean, you know, what I've said is that we're still in a secular bull market. So I believe stocks are going higher. But periodically we get warning signs and we get things that just don't quite look right, where it could be setting up for one of the pullbacks. I mean, if I'm bullish long term, it doesn't mean I expect the market to go up every day, every week, every month. We're going to have pullbacks from time to time. And from a short-term trading perspective, if you can identify those where we do get some pullbacks, that can help us quite a bit in trying to maximize our capital during these periods of pullback. So you can kind of move more into cash. You can trade a little bit, get in and out during the day if you want. I mean, that's kind of what I've been doing recently. But then I get back out because I just don't trust the market in the mornings, gapping up or gapping down. And so that's really what that was all about. So you nailed it. You were absolutely right in that, long term, I believe we're still in a secular bull market advance. I believe no matter what happens in the near term, I believe we're going higher later in the year. And so it's just trying to navigate these short-term periods where I do see some warning signs. That's really what we're doing with what I've been talking about.
So, all right, moving on. We got a question from Raj. He says, I use moving averages on stock charts for my trading rules. Now there are two different charts available. So which do the Wall Street elites use, the non-adjusted or the adjusted charts? And I'm assuming it's with dividends, but both can have different moving averages, is statement.
Yeah, I mean, you can adjust prices. Like if I pull up the spider, this is what I think just about everybody uses, but there is something where you can put in a underscore right before the SPY. And so instead of having a 601.46, well, 601.47. But I mean, there are some charts when you go back and you look at prior prices, they've been adjusted for dividends and the other one hasn't if you don't have this underscore. And I don't adjust for dividends. I use the regular SPY or any other stock for that matter. I just use the ticker symbol. I don't use the underscore because dividends, of course, I'm practicing CPA or was a practicing CPA. And one of the things you learn in accounting is that just regular dividends, they adjust the stock price, but only for a period of time until the dividend has been paid. Once the dividend has been paid, should be back to regular price action. So I don't go back and adjust for those short-term price adjustments. I just go with what, um, I don't know, go basic or go regular ticker symbol, whatever you want to call it. But I don't adjust prices for dividends.
Uh, Greg was hoping that you could pull up an S&P log chart and go back to 1987. He mentioned that if you take the high from 1987 and run it up until now, there's some interesting touch points, and wanted to get your thoughts.
Oh, let's see here. Well, of course, I always work with that 100-year chart, but we can pull up this one. So in 87, um, he was looking from the high or from the low.
I believe he said the high.
Yeah, I mean, I'm not really sure what, you know, from a long-term perspective, kind of what I would be doing is looking at something like, I don't know, something like that. Let me, so like there's a long-term trend line. And then what I would do is kind of drag this up and try and catch as many highs as you can. And you can kind of see where in this channel long term, um, end of 1998, 99, excuse me, end of 99 to and into 2000. You can see through this period we went outside the channel, but for the most part, that kind of comes in and you know, tests or touches those various highs. Um, And so that kind of is a long-term channel that I would use. And then the current secular bull market, what I would use is maybe use a thinner line, and you can catch the lows from 2009, and again the lows from or the low from 2020, and then you can take that line, and you can also drag that one and connect highs like that. And so what you end up doing, and the reason that the stock market does so much better in a secular bull market is that you start from a secular bear market low and you work your way all the way back up to the upper end of the channel, which is kind of where we are right now, which is another reason why I think we could have a pullback short term. It wouldn't surprise me just because of where we've been in terms of testing that high channel. But anyway, this is a secular bull market channel, and then this is just the overall channel. And what you'll see is that normally we will go from these lows, kind of like we did back in the 1980s as well. Oh, that's not what I wanted to do. Let me grab this. And so in 82, if we kind of go from that low and kind of move up to these lows, something like that. And then you'll see also if you try to come up here and connect ties, I don't know, probably looks something like that would be your secular bull market channel going up. But that's what you get. And then in these sideways secular bear market periods, you just simply go sideways to down. Usually having a final low that breaks slightly below the prior low. Just kind of give you that sense that, hey, things are getting worse. Usually that's a pretty good signal that it's time to get in. Both of those came right on the bottom uptrend channel lines. So I don't know if this helps, what you're looking for in terms of 1987. I don't really see anything with that 1987 high or low as far as how to draw lines at this point because they don't really connect with the highs that we've seen in recent years because of the huge breakout of the channel that we saw in the late 1990s, early 2000s. So hopefully that helps.
Yeah, I think that was, I mean, an awesome exercise right there. Um, so we're moving on. We got Sachi, scanning question from him. He was looking for a identifier where you brought up AMD from the EB Digest. I think it was last Wednesday. It was basically, I believe you achieved this by buying a stock that it has been through significant downtrends within a long-term uptrend. Basically, provides you a cheaper entry and raises your dividend yield.
Yeah, I think you said AMD, but I think you meant to say ADM.
ADM, yeah, I got a little dyslexic there.
That's right. Archer Daniels Midland. Yeah, this is one that again, it's a different style. If you're a short-term momentum trader, stay away. I mean, it's going down. You don't want any part of this. But what I was pointing out, I think, was from a long-term perspective, there are different ways to trade the market. And from a long-term perspective, I'd really like to get stocks that have pulled back over the course of a year or a couple years, few years, that have been in a long-term uptrend. So ADM was one that I talked about. And if you pull up a long-term chart, you'll see ADM went sideways for about 5 years, 2014 to 2020, and then took off and took out overhead resistance between 40, 45. That's where we had a lot of overhead resistance, and we went through it. And if you look at where we are now, we're back to 45. That was the area of the breakout. And so these monthly charts are no different than a daily chart. When you have resistance and you break through it, that becomes support. But it may take a while. In this case, we went all the way up to 95 or into the 90s. And now during the last 2 years, we've pulled back to a pretty key area of support. And I'll just, throw these annotations in here so you can kind of get a sense. These prior highs, but you can see all these tops that came across right about, anywhere in that 40, 45 area. We broke out. And now look at where we are coming back down, getting very close to key area of support. So if you can get into a stock like this that pays you a really nice dividend, and they have a history of raising their dividends, um, from a longer term perspective, I think this is a better choice because this is what you do when you're riding this up during the short term advance if you're a momentum trader. But if you're a long-term trader and you try to use momentum rules and you buy in when it's at a high well above the moving averages, that's the type of situation you could get into where 2, 3 years later, you've lost 50% of your capital. Now all of a sudden the dividend up here, your yield um, is it's not really helping you. I mean, if you get in here and you're getting a dividend yield of 3.5 or 4% or whatever it is, and they keep raising the dividend, and also you can hopefully count on somewhere down the road some capital appreciation. That's how I think from a longer term perspective you can accumulate wealth. So I think that's the point I was trying to make
Right.
is that if you're a long-term investor, I wouldn't necessarily be using short-term momentum strategies to time entry points, that you really would like to wait until stocks go through these pullbacks and then jump in. And what's interesting is this isn't just for dividend stocks. It can be for growth stocks as well. I remember not that long ago, I was looking at Lululemon, which had been beaten up pretty good here. And you can see the monthly PPO went all the way down to 40, which if you go back the last 16 years, anytime you've gotten the monthly PPO, or excuse me, monthly RSI down around 40, that's generally been a great time to jump in to Lululemon right here, right here. Here we went just a little below 40. But if you get in at those points over the long term, they make a lot of sense. So it's just using a little bit more weakness, that it stretches over maybe a year or a few years to try to get into cheaper prices. Also, that it helps your dividend yield. And if you're in companies where their dividend has consistently been raised for many years, you're kind of establishing a minimum dividend yield that you're going to get on that stock. And as it goes higher in terms of the dividend, your yield keeps going up to fight inflation, which is good. And then also you can be in position to benefit from any capital appreciation off these lows. So that was the main point. It's just looking at a couple different strategies.
Yeah. Awesome. So we got a newer member, Anthony. He's got a couple questions for us. Initially, he said, I see Tom uses the AD line on his charts. Was wondering if you could highlight why that one versus, say, OBV or the MFI index.
Well, the last one I don't really haven't used, so I'm not going to comment on that one, but I'm very familiar with the OBV. Um, the difference is, and you can go into chart school with stock charts, you can go through the definition and figure all that out. But the real difference is with a OBV, let's say stock's trading at $100 and it comes out with earnings and it gaps down to $90. And then throughout the entire day, it comes all the way back and closes at 99.99. So it's down 1 penny for the day. OBV takes all of the volume for the entire day. And if you finish down, it subtracts all the volume. It doesn't matter if you gap down to 90 and go down to 80, or if you gap down to 90 and you bounce back up to 99.99 on massive volume. Either way, all of the volume gets subtracted. I don't think that's, I don't think that's, that doesn't make any sense to me. Because if a stock gaps down and you've got massive volume and the stock's coming up all day long, to me, that's a sign of significant accumulation, not distribution. So the OBV on that example would treat all the volume as though it was bad volume and would just subtract it. But with the AD line, if you closed yesterday at 100 and you opened today at 90 and you finish at 99.99, you're down 1 penny. But the AD line only looks at the current day. It doesn't care about the gap down. So what it does is it looks, okay, you opened at 90, your high was 99.99, and you closed right on your high. That's a completely bullish day. And all your volume gets added under the AD line. So, I mean, I could probably, find a stock where something like that happens. Just trying to see. Let me see if I can come up with, I don't know, maybe like a Palantir. Just trying to see. Okay, here's a good example. So back in early August, if you look, you'll see that the AD line took a big move to the upside here. I'm going to go back and let me change a few things on this chart. So we want to go to the beginning part of August. So I'm just going to do 8:15. And I'm also going to do the OBV on here. And I'll do that above so we can look at both of them. There. Okay, so let's just take a look at these two. And I'm going back to this big candle right here, the big down, both of these down days. Do you see them? So OBV is going to take this increasing volume on both these down days and it's going to subtract it. So see at the beginning of August, the OBV line's coming down. AD line treats both of these bullishly because intraday you went down as low as 23.75, but you came back up and closed at 24.75, which was very near the high of the day. And then similar action the next day when you have the big gap down and then you come rallying back, finish near the high of the day. And so AD line treats this as a positive. OB treats it as a negative. So which one you follow depends on which one you believe. I believe that this is good action when a stock gaps down and there's a lot of positivity. And in this case, we did, end up rallying back to the upside. So I think the AD line gave you a much better signal moving up there than the OBV did by moving down. So that's just one example, but that's how the two are calculated. And I like what's going on during the trading day. To me, whatever happens overnight and into the opening bell can be orchestrated. There's not, in after hours trading, market makers, it's voluntary session. So market makers may or may not be participating in the action. Also, many times, most times, the after hours volume is much, much lighter than what we see during the trading day. So for me, I just think the AD line is a much, much better indicator than OBV. But that's my personal opinion. That's why you never see OBV on my charts and why you most of the time will see AD line on my charts.
Mhm. And we're sticking with Anthony. Great answer. He was wondering if you analyze any Bitcoin or any other cryptos and you had an opinion on them.
I, basically, I look at it. I don't trade them. I would only have opinion based on how they're trading on their charts. So if you go to the summary page, the dashboard or whatever at stock charts, you see this right above the market overview or you got equities, bonds, commodities, and then you got cryptos. So, we could pull up the cryptos here and just look at them. So I would look and I'd see, okay, XRP's up 6% today. Bitcoin's up 0.75%. And I could pull up the charts and maybe make some inferences based on how they're trading with one another. But I'm really much, much more interested just in whatever's working in terms of relative strength. I don't have any fundamental knowledge. I've never really studied these cryptos, which is why I don't like to talk about them too much. I think there are others out there that are probably, better equipped to talk about cryptos than I am. So when I pull them up, it'll basically be just to look at the chart or look at them relative to one another, just to see which one's outperforming over a period of time. But outside of that, I really don't have any comments.
Tom, do you ever consider relative volume to identify opportunities or warning signals?
Relative volume.
Yeah, same Anthony guy. Not sure if he's talking about off your relative charts, maybe.
The volume is going to be the same.
Yeah.
Whichever ticker symbol you list first is going to show volume. The only thing I can think of that the question might be asking is, some days market goes up or a stock goes up with big volume and then might come down with light volume. In that case, yes, I do follow volume. I think if the market is advancing and it's on heavier volume than it declines on, I think that's a good thing. Um, and likewise, if I'm breaking out on a stock and I'm evaluating the breakout and whether or not I want to trade it, I'm much more likely to trade it if I get confirmed action above the resistance area and I get that on heavy volume. If I get it
Mhm.
on light volume, it's almost a negative to me. A light volume breakout tells me that there's no real additional volume coming in on that push to the upside. And if there's a negative divergence on a company that's breaking out with light volume, to me, that's just adding to the bearishness. So, yeah, I absolutely look at volume. But when you say relative volume, I'm not quite sure where you're going with that, but hopefully my answered your question.
Sweet. So the last one I got for you is Tom mentioned that he had about a 15% of his retirement the other day in unnamed stocks. They were generally long-term dividend-paying stocks. He was wondering if you could go over some of those.
Yeah, I mean, I talked about them recently. I don't know if it was in maybe a live trading room or it was probably a few weeks ago. But yeah, I mean, there are some longer term charts that I'm looking at, just like I showed you with ADM. ADM is one of the stocks that I have, for instance, because I like that 40 to 45 range. And what I'm planning to do with these stocks, it's completely different than what I normally do, which may turn out to be bad. Maybe over the long term will be good. I guess we'll find out. But I just wanted to do something a little bit different that I wasn't trading all the time. And so I just took one of the smaller accounts that I have, and it is a retirement account. And just decided to see, over the next few years, what happens if I kind of apply the strategy I was just talking about. So when ADM, Archer Daniel Midland, whenever they pay a dividend, I'm going to take the cash. I'm going to reinvest it in the stock price. So if the stock keeps going down, I'll just keep adding in with some cheaper shares. But again, the key for me on these stocks is that these are stocks that have a great long-term track record. Many of them have very strong brands. Hershey's is another one. That one had been getting killed, recently starting to pick back up again. I think I started getting in. I think I got into this one probably somewhere around 170, maybe the upper 160s, and literally wrote it down to 140. That looks a little bit, well, maybe it's like a um, exhaustion candle. I'd like to see a little bit more volume for it to be an exhaustive type of gap. But if I look at Hershey's on a long term, their monthly 20-year, again, this is a stock that went down during the financial crisis, 2014 through 2016, when the market was, kind of going back and forth and just treading water. Hershey's did the same thing. Excuse me, 2018, we had a pullback, 2020 during the pandemic. But then we had a huge move. You look at Hershey's and say, wow, it's dropped a lot. It's really not a healthy stock. And on a daily chart, I would agree with you. I wouldn't buy it as a momentum trader. But if you look at it from a long-term perspective, this stock made a huge run off the pandemic low at 100 up to 260. And so now it's come back down to 150. So it's given back, quite a bit of that, but it's got a great long-term track record. And the other thing I showed with Hershey's the other day, which is kind of interesting, we just started jumping here the early part of February, but I've brought this up multiple times. If you go back over the last 20 years, this is when Hershey does all of its damage to the upside. It normally does well February, March, April, May, June, July. These next 6 months tend to be the strongest 6 months for Hershey's. And then August through January tends to be the weakest. And so, kind of line that up as well. So maybe seasonality kicks in, maybe Hershey's is coming back. But either way, I just like it for the long term. I think Hershey's is a great company. It's not really one that I'm worried about. Been around a long, 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 long time. And so I think it's a great value, pays dividend, pays nice dividend, and they have a history of raising their dividend going back into the early 2000s. So anyway, yeah, it's just a little different philosophy. That's all.
I think that's all I got. I think you said you wanted to go over some of the questions, maybe the live trading room on Wednesday you didn't
Yeah,
get to.
Yeah, I got booted out on Wednesday. My internet completely went out, didn't come right back. So ended up canceling. I mean, we'd already been in the room for an hour and 45 minutes. It wasn't like we weren't in there for long. But I did have some other questions that had come in. And so I wanted to take a look at those. I don't remember exactly where we cut off, but I'm going to pull up a few of these. One was Cava, CAVA. I think it's kind of worked its way back. It's now back above its moving averages. So I would probably just watch that rising 20-day moving average. I'd like to see that hold. PRCT was another one that was asked. It's come all the way back down and filled this gap when it had the huge volume gap up back at the end of October. So this is where I would kind of stop making excuses for it. I think somewhere in that 65 to 70 range. I mean, I think, you got this gap support over here as well. So I'm just saying 65 to 70, I think should hold this stock in terms of support. So I'd look for that. ISRG, really like this stock. Moved up with earnings, broke out above this sideways consolidation, pulled back. Essentially, we're holding that rising 20-day moving average. I think we still look pretty good there. INTA, I like this one. They also raised guidance. I just finished working on the raised guidance chart list. I know they raised guidance, stock gap down temporarily, came rolling back. I think right now it's in a trading range between 60 and current price, maybe even called 60 and 75. But I think this stock breaks out of that range to the upside. ADM, that was one that was asked. Just talked about it, so I won't spend much time here. But yeah, short term, as a momentum trader, leave it alone. Longer term, 40 to 45 looks pretty tempting. So it just depends, what kind of a trader you are there. GRMN, Garmin, another one of the stocks that was in our portfolio this past quarter. Been a great performer. It does look like we have a false breakdown. I, if I was still in the stock, I would sell it today. I don't like this candle at all. 220 was your high over here. We actually opened right around 220, 219.83, traded up to 223.33, an all-time high earlier today before coming back down and coming back down below that level. I don't like false breakouts like this after a pretty decent run. I would be taking profits. I think Garmin's a great stock. Maybe we pull back, maybe into the 205, 210 range, and might look a lot different at that point. But I don't like those reversing candles, and I tend to sell them as a short-term trader. TGI, earnings coming out 210. I don't know if they were acquired. This is normally the look of a company that's been acquired, Triumph Group. And it's probably a cash deal, because if somebody offers up their stock, normally, if Triumph is following another company's stock price, you'd see it go up and down. So this looks like it was probably something like a $25 cash offer. That's what I'm guessing. So I don't really think there's a whole lot to do here. Even with earnings, TGI is not going to move with earnings if they have a buyout offer. The company that bought them, maybe they might get a positive if the company reports good results. MLI, I think it was mentioned that it was a strong buy on Seeking Alpha. That doesn't do anything for me. I don't care who's putting out strong buys. I just look at the charts. I think you've got gap support in here at about $72 up to the top of gap support, which looks like it's about $78. So I think this $6 is a range. I mean, if you can get back up and break above 85, I think that would be a really bullish move on MLI. But in the meantime, I just think we're in this 72 to 85 range. Two more, SOUN. This one, I believe, was very heavily shorted. I don't know if it's still on the short squeeze list, but I know at one point it was. And that was part of what was going on here to the upside. Saw a lot of volume coming in, which I think was short squeeze volume. We've settled back down. If we can get back through 17.5 to 18, maybe that volume will start to come back in again. And we can kind of rekindle that short squeeze. Otherwise, right now, it's just in a trading range from about 12.5 up to about 17.5. And the last one was WHD. I know folks have asked me, do I still like this stock? When I was talking about small caps doing really well, expecting small caps to do well, this is a stock that I said, hey, we could see a triple on this stock. That was, of course, based on the fact that I believe small caps were going to do a lot better. Small caps have since pulled back. Also, this is an energy stock, and crude oil prices have dropped. So you got two things going against the stock. I still like it. I think your key support right now is at 56. The big resistance area is all the way back at that November high near 70. Right now, we're kind of trading in the middle, closer to 61. So I just think it's, back and forth in a range. I'm expecting that the next big move on the stock will be a breakout to the upside, not to the downside, but we'll see. Go from there. But anyway, that was it. So, Matt, if you don't have any other questions, we'll wrap this thing up.
I don't, but I will mention that Triumph was acquired by Warburg Pincus and Berkshire Partners.
Okay,
So just throw that out there. Yeah, nailed
awesome.
it on the chart.
Yeah, usually when you see a stock gap up and it just stays at that level for a period of time, that is normally a cash offer. And like I said, if it's a stock offer, if somebody's, using their stock as currency, then, the what was that? That was TGI. Yeah. So
Yeah,
TGI
yeah.
shareholders here are just going to get $25 cash. But if it's a stock buyout, they're going to be paid in the stock of the acquirer. And so the TGI stock, until it closes, will start to move with that acquiring company stock. So anyway, just something to be aware of. But that's it. We certainly appreciate everybody tuning in. Again, if you like these, Q&A sessions that we do, write into us. Let us know. Send your comments into support@earningsbeats.com. Matt will get those and share it with the rest of our team. But we certainly appreciate all of you. We are trying to get out there and answer as many questions that we can that you have. So hopefully you enjoyed this Q&A session. Enjoy your weekend and happy trading.